households are going to get crunched again, because yesterday the RBA unanimously decided to hold rates at 3.6%. And importantly, Michelle Bullock called the end to the truncated easing cycle after delivering the 75 basis points of cuts between February and August.
So as you see, today the board decided to leave the cash rate unchanged at 3.6%. Inflation came in a bit stronger than expected in the September quarter. Some of this looked to be temporary factors, but there were signs of persistence in some items. The board discussed how much signal to take from the new monthly CPI and concluded at this early stage in the series it needs to be cautious. The board is nevertheless alert to the signs of a more broad-based pickup in inflation. The labour market has evolved broadly as expected and remains a bit tight, and the national accounts last week showed GDP growth was broadly in line with our November forecasts. That said, growth in private demand was a bit stronger than expected, largely driven by business investment. Growth in household consumption was largely as expected. The outlook for the global economy is also more balanced than earlier this year, although downside risks remain. So as you know, the board's been very cautious this year as it's eased policy. It's highlighted the possibility of upside risks in our assessments, particularly degree of tightness in the labour market. And indeed, the recent run of data suggests there may be more tightness in the economy than previously assessed. The board therefore assessed that the balance of risk to inflation had tilted a bit to the upside. This is while downside risks, particularly from overseas, seem to have abated a little bit. We've also been mindful of the timing of electricity rebates and their temporary effects on inflation data. Rebates temporarily lower headline inflation, and as they roll off, the headline inflation will move higher. The board looked through these effects when rebates were put on and is going to do so again as they come off. Before the next meeting, we will receive more data on the labour market and inflation, including quarterly trimmed mean. These will be important inputs into our updated forecasts and for the board's deliberations in February. We remain focused on returning to inflation to target while maintaining the unemployment rate as low as possible. Taking a longer view, our inflation and full employment objectives are complementary. Keeping inflation low and stable enables strong and sustainable employment growth. So the board will be driven by what the incoming data tell us about where the economy has been and what this means for the outlook.
That was significant in that rate cuts, well, are now off the table, and it's a toss-up between an extended interest rate pause or worse, a switch to lifting rates in the light of sticky inflation.